Welcome to Two Beans in a Pod, your direct path to truly understanding complex topics. Today, we're embarking on a deep dive into something pretty significant, something poised to profoundly reshape, well, our financial landscape, and maybe even our fundamental freedoms. We're talking about a proposed piece of legislation in the Senate. It's known as the Genius Act. Now, you've generously shared some really incisive sources with us on this, and our mission for this deep dive is to clearly unpack what this bill proposes, what it aims to achieve, and maybe most importantly, explore some very significant concerns about financial control, potential corruption, raised by an expert whose perspective we've encountered in these sources, Catherine Austin Fitts. Our goal is to explain it all in, plain language, connect the dots, so you can walk away from this conversation not just informed, but genuinely insightful.
Okay, so to set the stage a bit, the Genius Act, it actually stands for Guiding and Establishing National Innovation for U.S. Stablecoins of 2025. It was introduced in the Senate back in February 2025. And at its heart, its main purpose is to establish a clear regulatory framework, specifically for what it defines as payment stablecoins.
Okay, right. Let's unpack that. Because for many of our listeners, the term stablecoin, that's probably familiar. But what specifically does the Genius Act mean by a payment stablecoin? And, why is that distinction so crucial here?
That's a great question. So yeah, you're likely familiar with stablecoins generally. Digital assets designed to keep a stable value, usually pegged, like one-to-one with a fiat currency like the US dollar. But the Genius Act really drills down. It defines a payment stablecoin as a digital asset specifically intended for use as a means of payment or settlement. And the issuer, well, they're legally obligated to convert it, redeem it, or repurchase it for a fixed amount of monetary value. So maintaining that peg, that one-to-one with the US dollar. The crucial distinction, as the Act itself states, is that these are not considered national currency.
Okay, not national currency.
No, nor are they traditional securities. And this classification, well, it's vital because it determines exactly how they get regulated.
Got it. And what about who actually gets to issue these things? Does this act, open the floodgates for anyone, or does it put limits on that?
This is where it gets very specific. Very specific indeed. The Act imposes pretty strict limitations. It kind of funnels the issuance only to what it calls permitted payment stablecoin issuers. Now, this largely means subsidiaries of already insured depository institutions. Think your big banks.
The established players.
Exactly. Or certain non-bank entities that have received specific approval. But the key insight here, the real takeaway, is that it makes it explicitly unlawful for anyone else to issue these payment stablecoins within the U.S. So it's a very clear move towards, centralizing control over who gets to create this type of digital dollar.
So if I'm getting this right, the Act isn't just defining what these stablecoins are, it's also really limiting who can create and distribute them. What does that centralization of issuance mean for how these stablecoins would actually, function day to day? What are the practical rules for these permitted issuers?
Precisely. And the Genius Act lays out several really stringent requirements for them. It focuses heavily on, one, solid backing, and two, very importantly, transparency. Now, the core insight on the backing part is just how prescriptive it is. Highly prescriptive. These stablecoins, they must be backed, at least one-to-one, with highly liquid assets. We're talking essentially the safest, most readily convertible forms of money.
Okay, so what specifically?
Think U.S. cash, actual coins, and currency. Demand deposits at insured banks, very short-term government bonds, specifically Treasury bills maturing in 93 days or less. Also, certain short-term repurchase agreements, specific money market funds invested only in those assets, and central bank reserve deposits.
Wow. Okay. So really safe stuff.
Extremely safe stuff. The crucial point here is that stringent requirement. Backing only with the most secure assets. It's designed to eliminate volatility, ensure immediate redemption for the consumer, no funny business with risky assets.
And transparency, you mentioned that's a big part too, right? It's not just what they're backed by, but how everyone knows about it.
Absolutely. Transparency is huge here. Issuers are required to publicly disclose their redemption policy. They have to establish clear procedures for timely redemption of any outstanding payment stablecoins. But beyond that, they have to publish monthly the composition of their reserves right there on their website.
Monthly.
Yes, monthly. And this isn't just like a simple statement. It means showing the total number of stablecoins out there and the exact amounts and types of reserves they hold, down to the dollar.
Okay, that sounds pretty rigorous.
It is. And it's not just a self-report either. This data must be examined, not quite a full audit, but examined monthly by a registered public accounting firm. Plus, the CEO and CFO of the issuing company, they have to personally certify the accuracy of these reports.
And there are penalties if they don't.
Oh yeah, criminal penalties for false certifications. So it's a very robust framework, really designed to build public trust and confidence.
Okay, this certainly sounds like a significant push for stability, for oversight, accountability, trying to build consumer confidence in this digital asset space. But, and this is a big but, this is exactly where our sources introduce a radically different lens, a totally different way to view these developments, a perspective that kind of transforms this conversation, right? From one about regulation to one about fundamental control. Our sources introduce Catherine Austin Fitts. She's a former Assistant Secretary of Housing, and she views moves like this with, well, deep skepticism. She warns that these efforts to digitize currency, even if they seem like they're just about stability, could actually be part of a much broader system, a system designed to control people through their money.
Right, and if we connect this to the bigger picture, the Genius Act, while yes, likely genuinely designed by many proponents to bring stability and trust to stablecoins, it does lay the essential groundwork for what critics like Fitts call programmable money.
Programmable money. Explain that a bit.
So the core insight Fitts is really pushing here isn't just about programmable money as a concept in the abstract. It's that a seemingly benign act, one focused on stability, could, maybe almost inadvertently, be building the essential infrastructure for that deep algorithmic control over our finances.
Okay.
We're talking about dollars encoded with specific logic, money that could, theoretically, have an expiration date.
Expire, like your money could just disappear if you don't spend it.
Potentially, yes. Or it could be restricted, maybe only usable for certain types of purchases, but not others. Or even be reversed automatically based on, say, compliance rules or certain behaviors.
Wow.
Now, proponents of this concept might argue, hey, this offers incredibly efficient financial tools, for policy implementation or preventing fraud, but it raises very, very serious civil liberties concerns. Concerns about the potential for limiting spending based on behavior or even denying individuals access to their own money based on factors outside traditional legality.
So is Fitts just talking about financial regulation here or something? No, deeper. More unsettling.
Oh, much deeper. She argues that what's being built here is an invisible corral. That's her term.
An invisible corral?
Yeah, a system designed to subtly fence people in through their financial transactions, limiting their choices without any obvious physical barriers. And she takes it a chilling step further. She suggests it could eventually lead to what she calls a digital concentration camp.
That's a very strong term.
It is. And she uses it to convey a future where financial control becomes so absolute that it restricts fundamental freedoms, restricts economic participation based purely on digital compliance, whether you're following the rules embedded in the money itself.
Okay, wow. And this links back to surveillance, right?
Exactly. This raises huge questions about the potential for pervasive financial surveillance. The Genius Act, remember, places a strong emphasis on AML, anti-money laundering, and KYC, know your customer compliance. Standard stuff in banking, sure.
Right.
But critics like Fitts contend that this emphasis, while seemingly benign, could lead to a massive increase in account monitoring, blacklisting of individuals or groups, or even restrictions on what are considered permissible transactions. The core concern is that this would fundamentally erode financial privacy, and it could severely limit economic activity for anyone deemed, undesirable by the system for whatever reason.
And she argues this isn't just theoretical, right? She points to examples.
She does. She points directly to the situation with Canadian truckers a while back, where their money, and even the money of people who supported them, was effectively cut off, frozen.
I remember that.
Or she mentions legislation recently passed in Tennessee specifically to prevent banks from debanking people for political or religious reasons. Why? Because there's currently no federal law protecting against that.
So for her, these aren't just hypothetical fears. It's a trajectory she sees already unfolding.
Precisely. And this also connects directly to the whole idea of digital identity. The Act, by reinforcing those strict KYC requirements, reinforces this broader trend. The trend of requiring government-approved identification for access to pretty much all financial services.
Like a digital passport just to use money.
That's the worry. Critics warn this could create a closed-loop system, a system that effectively excludes anyone without the right kind of compliant identification. And it significantly expands state oversight over, virtually all financial transactions.
Okay, this is getting heavy. And Fitz goes even deeper, doesn't she? She points fingers at who she thinks is really behind this.
She does. She points to what she calls the central banking bureaucracy as the true power driving this entire movement. And she specifically calls out the Bank of International Settlements, the BIS, based in Switzerland. She calls it, well, her words, the head of the criminal snake.
Wow, head of the criminal snake. Why such a loaded description for the BIS? What's her take on them?
She describes the BIS, which is in Basel, Switzerland, as operating with sovereign immunity, essentially meaning it's above the law, which, she claims, allows it to move and hold money secretly, right on its own balance sheet, totally outside of public scrutiny or national oversight. And she makes a really explosive allegation. She alleges that colossal amounts of money, she specifically cites $21 trillion between 1998 and 2015, have just disappeared from the U.S. government accounts. Unaccounted for.
$21 trillion.
That's her number. And for Fitz, this isn't just like bad accounting or bureaucratic waste. She links it directly to what she calls a financial coup.
A coup?
Yeah, essentially a quiet, nonviolent seizure of power over financial policy. And she suggests this money funded the creation of a breakaway civilization, implying an elite group operating with vast, unaccountable resources and power, totally outside the traditional public sphere.
That $21 trillion figure, I mean, it's staggering. The core insight Fitz seems to be driving at isn't just mismanagement, it's the chilling idea that this disappearance wasn't accidental. She frames it as a deliberate funding mechanism for some kind of parallel system, potentially operating entirely outside democratic oversight. That's profound.
Yeah.
And deeply disturbing.
It's a very serious claim, absolutely. It posits these missing funds as the fuel for a hidden power structure.
So how does the Genius Act, even if maybe unintended by some of its supporters, feed into these broader concerns about control and centralization that Catherine Austin Fitz is talking about?
Well, her view, her historical narrative is that bankers effectively seized control of monetary policy back in 1913 with the Federal Reserve Act. And now, through initiatives like regulated stablecoins, central bank digital currencies, things like that, they're attempting to fully take control of fiscal policy, too.
Fiscal policy, like taxes and spending.
Exactly. Taxes, government borrowing, the whole lot. She even cites a former nominee for controller of the currency, who apparently, in an article, suggested that a central bank digital currency could be the perfect tool to deal with inflation. How? By allowing the central bank to simply freeze everybody's bank accounts.
Freeze everyone's accounts, just like that.
That was the suggestion reported. It's a very blunt and frankly alarming statement, especially to a critic like Fitz, who sees it as confirmation of this control agenda.
Wow. We're definitely covering a lot of ground today, from the nuts and bolts of this legislation to these truly profound warnings about the future of money and control. We really hope you're finding this deep dive into the Genius Act and its potential implications as well eye-opening as we are. If you are, remember to hit that like button. It really helps us out. And if you haven't already, please make sure you subscribe to our channel so you don't miss any of our future explorations. Your support genuinely helps us keep bringing you these kinds of in-depth analyses.
Okay, so shifting back a bit to the Act itself and its more immediate impacts, according to the sources. The Genius Act explicitly, or at least implicitly, outlines who kind of wins and who struggles within the current crypto ecosystem. It clearly benefits the existing regulated stablecoin issuers. Think Circle's USDC, PayPal's PYUSD, they're already positioned to comply.
Makes sense.
Also, the large traditional banks like JP Morgan, who can easily launch their own compliant stablecoins under this framework. And it also seems to allow state-regulated fintech startups, provided they stay under a $10 billion issuance cap, to operate and potentially flourish.
Okay, so it helps the big guys and some regulated smaller players. Who does it potentially hurt?
Well, it may significantly challenge the truly decentralized stablecoins, things like DAI, which relies on algorithms and collateral, or FRX, also potentially other decentralized finance or DeFi tokens, and especially privacy coins like Monero.
Why them specifically?
Because of the incredibly strict compliance, auditing or examination, and transparency requirements it imposes, things that are fundamentally difficult, maybe even impossible, for truly decentralized or privacy-focused projects to meet.
So if I'm hearing this correctly, the Act, just by its design, seems to funnel innovation and financial activity towards the big established players, the traditional banks, the heavily regulated fintechs, and maybe at the expense of the more, let's say, permissionless or decentralized corners of the crypto world. Is that the potential long-term impact, sort of mainstreaming that actually consolidates power?
That's precisely the concern highlighted in the sources, yeah. While proponents will argue this brings stability, legitimacy, consumer protection.
Yeah.
Critics contend it creates innovation bottlenecks for those smaller, more experimental, decentralized projects. And ultimately, it leads to a concentration of market power among large banks and fintechs. It's kind of like even if the digital money itself runs on a decentralized blockchain. The underlying plumbing, the companies providing the essential services, the oracles confirming data, the custodians holding assets, the APIs ensuring compliance, those could still be very centralized. These tech stack companies could effectively become the new gatekeepers, creating a kind of soft centralization where control quietly shifts to a few key infrastructure providers, even if the digital asset itself looks free and open.
That makes sense. It sounds like even if the asset itself is digital, the fundamental control points, the levers of power, could remain highly centralized, maybe even more so. What about the global picture? Is there a geopolitical angle to this act?
Oh, absolutely. There's a very clear geopolitical dimension discussed. The act's proponents argue, look, this framework will bring much greater trust to crypto payments. It will significantly increase institutional participation, big money coming in, and provide clearer pathways for robust consumer protection. But on a global scale, it's also explicitly aimed at reinforcing the US dollar's dominance.
How so?
Especially in the face of these de-dollarization efforts you hear about, like from the BRICS nations. The goal is to make the dollar more accessible, programmable, and competitive on a global scale through these regulated dollar-pegged stablecoins, a sort of digital upgrade for dollar hegemony.
Okay, so it's definitely a strategic move on the global chessboard, too. But going back to Fitt's concerns, they highlight a much deeper struggle, don't they? Almost a philosophical one. She argues that the federal government, particularly since maybe World War II, has been effectively buying people out of the Constitution. That's her phrase.
What did she mean by that?
By consistently providing funds, benefits, entitlements. She believes this leads to a situation where people prioritize their check, their immediate financial security or gain, and they prioritize that over tackling systemic corruption or defending fundamental principles or questioning where the money comes from.
Right. She illustrates this very vividly with her red button story. Have you come across that?
Tell me about it.
She describes asking a group, supposedly spiritually committed individuals, this question. If there was a red button and pushing it would stop all hard narcotics trafficking worldwide tomorrow, but pushing it would likely upset powerful interests, maybe cause market turmoil, maybe your taxes go up, maybe your 401k takes a hit. Would you push the button?
And what was the response?
She says, out of 100 people in this group, typically only one person would say yes, they push the button.
Only one. Wow. That red button scenario is incredibly illustrative, isn't it? It really challenges us on how deeply we prioritize certain comforts or perceived financial stability over tackling huge systemic problems, even criminal ones.
Exactly.
So for Fix, the core of this potential financial control isn't just about bad policy or technology. It's about a profound moral compromise that she thinks we as a society are making, maybe unconsciously. Trading freedom for perceived security or immediate gain. Is that the key lesson from that anecdote?
That's precisely it. For Fitz, the ultimate solution isn't just about tweaking financial regulations or choosing one technology over another. It requires a profound cultural shift, a shift towards prioritizing true wealth.
True wealth.
Yeah, meaning living wealth. Things like health, community, knowledge, a clean environment, an unpoisoned society, valuing those over just abstract financial gain. And ultimately, she believes the path to real freedom lies in fundamentally decentralizing economic power back to individuals and communities and prioritizing personal and national sovereignty.
Well, this has certainly been quite the journey. We've gone from the intricate legislative details of the proposed Genius Act all the way to these profound, almost existential concerns about financial control, surveillance, and individual freedom raised by Catherine Austin Fitts. The act, while it clearly promises stability and maybe greater mainstream adoption for digital currencies, it also just as clearly ignites this much broader, much deeper debate about where the future of money and perhaps society itself truly lies.
Yeah, the sources really frame this whole era as the Great Reset in motion, a period where these fundamental paradigms, control versus freedom, centralization versus decentralization, regulation versus permissionless innovation, are being fundamentally reshaped right now. And the crucial question for us, and really for you, the listener, is whether this massive transition, this digitization of everything, will it ultimately enhance accessibility and trust within the financial system, make things better, fairer? Or will it accelerate financial surveillance, increase centralization, and potentially erode individual sovereignty and economic freedom.
It really forces us to consider a truly provocative question, doesn't it? As our financial world becomes increasingly digital, will this technology fundamentally enhance our access and efficiency? Or will it inadvertently, perhaps, accelerate financial surveillance and centralization, forcing us into a difficult choice between perceived convenience, maybe even government benefits delivered digitally, and our fundamental economic sovereignty, our ability to transact freely? That's the critical balance, the tightrope walk, perhaps, for you to reflect on as you consider the future of money. If you want to continue exploring these complex and sometimes uncomfortable topics with us, please remember to hit that like button and subscribe to the channel. Your engagement, your support, it truly helps us in our mission to unpack the most important information for you.
Thank you for listening to Beans in a Pod.